The evolution of software taxation, navigating the cloudy skies. The digital world has transformed, but has tax policy kept up? In the early days of the internet, software was a physical commodity, but now, it's a service in the cloud. As New Zealand's Inland Revenue acknowledges, the tax rules need an upgrade, too. They've initiated a consultation to modernize the income tax treatment of software development and SaaS customization costs, sparking debates among businesses and tax experts. What's the current state? The consultation aims to understand the challenges businesses face when dealing with software-related expenses. While specific policy proposals are not yet on the table, the paper hints at Inland Revenue's thoughts on the matter. Software development expenditure. Trading stock approach. Once upon a time, software was sold on disks, and development costs were immediately deductible. Now, with software as a service, this approach is outdated, except for full copyright sales. Depreciation approach. With software distributed under licenses or as a service, Inland Revenue suggests capitalizing development costs as depreciable intangible property. This method raises questions about what, how much, and when to capitalize, especially with the iterative nature of software development. R&D approach. Under the Income Tax Act, research and development expenditure can be fully deducted or carried forward. However, applying this section can be tricky, and it may lead to asymmetric results, with deductions allowed but gains from asset sales potentially non-taxable. Inland Revenue's perspective. Inland Revenue believes the current methods for determining deductibility are generally okay. However, they're curious about whether the unique nature of software development warrants different treatment. SaaS customization costs. The consultation also tackles the expenses businesses incur when customizing SaaS applications owned by third parties. These fall into configuration, adjusting settings, and customization, modifying code. The tax treatment depends on whether these changes create an intangible asset. Inland Revenue's 2023 guidelines suggest these costs may be deductible as development expenditure or treated as depreciable intangible property. However, the current law complicates this, requiring compliance with both general permission and capital limitations. Deloitte argues that aligning tax treatment with IFRS would simplify matters, reducing compliance costs for what is essentially a minor timing difference. The controversy. But here's where it gets controversial. Deloitte challenges Inland Revenue's view, suggesting that allowing SaaS customization costs to be deductible is not untenable. They advocate for a more straightforward approach, aligning tax treatment with accounting practices, and propose a de minimis rule for non-IFRS taxpayers. What's next? The consultation is open for feedback until January 30, 2026. This is your chance to have a say in shaping the future of software taxation in New Zealand. Will the tax policies catch up with the digital revolution, or will they remain stuck in the floppy disk era? Share your thoughts and contribute to the discussion.